So guys, in the previous session, we were doing Ind AS 101. We have covered all the mandatory exceptions. We have discussed a few of optional exemptions, uh, and a couple of very important exceptions are yet to be discussed, and a lot of questions are there. But before we move further, it's better we put a note to all the concepts we have covered in optional exemptions. So in optional exemptions, we have covered share-based payment exemption, which is a very important one. Ind AS 21 related one is paragraph 46 say a continuance is allowed. That is one point. And the entities who have this FCTR reserve in their balance sheet, they can reset that balance to 0. This then relating to PPE, ITA, and intangible assets, we have seen one very beautiful option exemption, that is Ind AS 16 or Ind AS 38 can be applied retrospectively. That is anyway there. If you say you are not in a position to apply retrospectively, it's very impracticable for you, then you can go with a fair valuation on the date of transition. If you say, sir, that also is difficult for us, then the standard says you can carry forward the carrying amount, that is the net book value in the old Gaap as a starting point into the Ind AS. This is a very major relief for most of the entities. As far as investment entities are concerned, they don't have the fair value option. Sorry, not investment entities, investment properties are concerned, they don't have the fair value option. They can apply Ind AS 40 retrospectively, or they can simply carry forward it. So at the book value, that's it. So these points are there. This we will document, and then we will move further, sir. Okay. So optional exemptions heading you put in that. First one, share-based payments. For options on equity instruments which are vested before the date of transition, entity has following options. Or if I say again that option, this option get confused. Following choices. Choice 1, choice 2, apply Ind AS 102 retrospectively. This is one choice. If you are asking an entity to do apply the first choice, that means they are actually not taking any exception or exemption from Ind AS applicability. But the choice 2 is no need to apply Ind AS 102 retrospectively. Now in choice 1, just to add one more point, you can apply Ind AS 102 retrospectively if the entity has disclosed publicly the fair value of those equity instruments. So this is for vested, sir, vested options. For unvested options, Ind AS 102 has to be applied. Of course, retrospectively. So there you go, sir. This is regarding share-based payments for adjustment. PP, intangible assets. For these, the entity has the following choices. Number 1, to apply Ind AS 16 retrospectively. So this is one option. To fair value the asset on date of transition and treat such fair value as deemed cost. C, continue the carrying amount as per previous Gaap. For investment properties, so here in the A16 I wrote, please strike off the term 16 because it can be 38 as well. For investment properties, fair valuation is not permitted. It has to apply only cost. So this is the second one which we have discussed. Third one, is related to cumulative translation difference. Any balance of FCTR created as per AS11 can be adjusted directly into retained earnings. See, if it is Ind AS 21, if you get anything in the likes of FCTR, it is an OCA item basically, right? But in AS11 there is nothing like OCA. So in AS11, for non-integral operations, you might have created an FCTR balance. That FCTR you can merge directly into retained earnings, and from hereafter all exchange differences will be parked into FCTR as Ind AS 21 guides you. But existing FCTR you can kill it by transferring it to retained earnings. Next one. Paragraph 46 or 46A of AS11. See, what is paragraph 46, 46A of AS11? In AS 21 we have discussed it. Okay, so again detailedly what is 46, 46A I am not explaining. I am just writing the principle that is given in India's 101. In respect of long-term foreign currency monetary items, if the entity has elected to apply accounting treatment given in para 46 or 46A of AS11 in its previous Gaap, the entity has the choice to continue applying para 46, 46A even under Ind AS in respect of those long-term foreign currency monetary items existing on the date of transition see the term given is continue applying. If you have already applied paragraph 46, 46A while doing AS11 in the past, now when you are welcomed into India's, now also you can apply paragraph 46, 46A in respect of those items for which you are already applying. For example, you do a new foreign currency loan or you give a new foreign currency loan, for that you are not allowed to touch paragraph 46, 46A. On the other side, another issue is, in the past you never applied paragraph 46, 46A. Now you cannot start. If you are already applying paragraph 46, 46A under old Gaap, then you can continue that, but you are not allowed to start today. So guys, this is one adjustment. And then after this we have discussed investment. Investment in subsidiaries, associates and joint ventures. Entity has the following choices: cost as per Ind AS 27, B fair value on date of transition, previous Gaap carrying amount and date of transition. That's it, sir. So 2 or 3 more important optional exemptions are there. Once these are done, we can go and hit the questions given in the study material. So there are good questions. We'll finish it off. Sir, I hope you all have copied this. It's a simple one. Let's move on further, guys. This is combination related adjustment. That's a good one. And then there's a compound financial instrument one that also we'll cover. Yeah. See, sir, normally compound financial instrument accounting, you remember from India's 109, we split the equity component, we split the equity and debt component. The debt component usually gets accounted under ACM. Equity component, there won't be any accounting hereafter, you just park it under equity. Finally, ultimately, on the date of conversion or on the date of redemption, you know how to do the accounting. Sometimes there will be an option that can be exercised by the holder, that can be exercised by the entity. All that discussions we have done in India's 109. Now, in old Gaap, that is in normal accounting standards, you don't have any standard relating to financial instruments. Since there is no such standard relating to financial instruments, so generally all these compound financial instruments were entirely accounted as equity or entirely accounted as liability. Now, on the date of transition, what are we supposed to do? On the date of transition, what are we supposed to do? That is the discussion we are doing. Now, in this, they have given only one line of explanation, and after that they have thrown up an example. In that also one correction has to be made. Anyway, let's read what they have given. A first-time adopter need not split the compound financial instrument into a separate liability and equity component. That means splitting into equity and liability, that is not required when if the liability component is not outstanding on the transition date. That means this is the exemption given, sir. I hope you are able to understand. The exemption is if all the contractual payments have been made. That means there is no liability component outstanding on the date of transition. If there is no liability component, then there is no point of you splitting and also going and doing a retrospective effect and all. That means if the liability component is existing, then what should I do, sir? Then what should you do? Obviously, you have to apply India's 109 retrospectively. See, by default, the rule, if you remember, you have to apply all the indices retrospectively. We are studying some exceptions and exemptions. If you are not covered under these exceptions or exemptions, then obviously you have to apply the remaining provisions of India's retrospectively only. You know, that follows without saying specifically. So the exemption is this. Now let's read this question. This question is not based on this exemption. In this question, you got to apply retrospective effect basically. But anyway, let's read. On 1st April 2001, Sigma issued 30,000 6% convertible debentures on the face value of rupees 100 per debenture at par, rupees 100. Okay, the debentures are redeemable at a premium of 10% on 31st March 05, or these may be converted into ordinary shares at the option of the holder. So holder ki choice is there. Very good. The interest rate for equivalent debentures without conversion rights would have been 10%. This is market interest rate, so 10%. The transition date into India is 1st April 2003. Now, as you can see there, 1st April 2001 is the issue date. Redemption date is 31st March 2005. That means it has got a life of 4 years. It has got a life of 4 years. And your transition date is 1st April 2003. That means 1/4/2001 you issued, 1/4/2003 is your transition date. That means already 2 years have been over, 2 years are pending. Suggest how Sigma should account for this compound financial instrument on the date of transition. The present value of 1 rupee, PV factors they have given. That's okay. Okay, now I have to tell you before we do the retrospective effect and all. See, first in our old Gaap, in our books of accounts, as per accounting standard, what is the carrying amount that we should know, right? Because new carrying amounts, I will tell you, as per India's 101, we have to work out and see. But existing carrying amount also we have to work out now, so that a difference where to bridge and all we have to learn. Now, existing carrying amount in as per normal accounting standard, general Gaap, as you see, 30,000 debentures issued, face value is rupees 100. What is the entry would have written? Bank account debit to debentures, 30 lakhs, 30 lakhs. So 30 lakhs will be anyway there. What about this 10% premium? How you would have accounted? See, in the absence of any specific accounting standard which covers on how to do accounting for loans and all, there are various principles, sir. If you remember, in case of debentures issued at par, redeemable at premium, if you remember, we used to write an entry like this: bank account debit, loss on issue account debit, to debentures, to premium on redemption of debentures. This is one type of accounting. Mostly, I think your study material also accepted this entry. We have done sums on this in your basic level of IBCC and all. There is another version. Look at this: bank account debit to debentures, 30 lakhs, 30 lakhs. Sir, what about premium? I will not write now. Now, how much is the premium if you work out? In this 30 lakhs, 10% is a premium. So 30 lakhs into 10%, 3 lakhs. So what I will do is, if 3 lakh rupees, since the maturity period is 4, over a period of 4 years, I keep on recording. So at the end of each year, I write loss on issue to premium on redemption, which is 75,000. Now you see, in this model, the accounting effect will be same. In this model, what will happen is, I write 30 lakhs, 30 lakhs, 3 lakhs, 3 lakhs, I'll record. A 3 lakhs of loss on issue, I'll amortize it to P&L account over a period of 4 years. In the second alternative, what I told you on the right hand side, even that alternative will ultimately result in you debiting 75,000 each year to P&L account. Now here, the study material has given one carrying amount there. That carrying amount, how they have determined, I will tell you that is wrong. But later on they rectified in the latest study material. Latest study material they have rectified, sir. Anyway, I'll just show you. You must know that principal amount is anyway outstanding. That is 30,000 numbers into 100, 30 lakhs. That is anyway there. After that, what they have done, 30,000 into 100. This is the face value. Into 10 by 100, 10%, which is premium on redemption. And sorry, 30,000 into 100 into 10%, 3 lakhs, premium on redemption. Into 2 by 5 they have written. 2 by 5. What is 5? Where is 5 at all? They have wrongly understood that the life is 5 years and therefore 2 by 5 represents a 2 years accumulated premium in his total life of 5 years. But our question says our life of the debenture is only 4 years. So here there is a mistake. So what you all should do is, instead of 2 by 5, you should be writing here 2 by 4. Consequently, this amount will become 31,50,000. So in the 31,50,000, what is there? 30 lakhs is the principal amount, and then 75,000 is premium on redemption relating to first year. Another 75,000 is premium on redemption relating to second year, like that. So guys, this 30 lakhs and 75,000, which is premium liability of the first year, another 75,000 premium liability of the second year, total makes it to 31,50,000. This is the carrying amount as per your existing Gaap. Now, as per India's, how it has to be, that we have to sit and work out. Now you see, sir, the exemption given to you is this. What is this exemption? If there is no liability component outstanding, then you are allowed to not split the liability, that is the compound financial instrument at all. You need not do any split accounting if liability component is not outstanding. But in our case, the debentures have a life of 4 years, right? Until now 2 years have already been passed. Another 2 years is there. In the next 2 years, interest obligation is there. And after 2 years from today, if the debenture holder asks equity shares, I have to give equity shares. If he doesn't ask equity shares, then I have to pay cash. That means obligation to pay cash is there. That means liability is existing. That means the above exemption does not apply to you. You have to do a retrospective accounting. So retrospective accounting means what now? What is the retrospective accounting? On the very first day, had you applied Ind AS 109 for this compound financial instrument and did the split accounting as mentioned under Ind AS 109, by today, by 1/4/2003, the transition date, what balances would have been there in equity and in CFI liability? Amounts you have to bring it to your balance sheet today in place of 31,50,000. That's all you have to do. Now, so this first he explained what is the exemption, that exemption is not applicable and all. So first what he did is he split the equity and the liability component. Okay, so here you go. Now what he has done is he has done it for one debenture, sir. One debenture with a face value of 100. For that he has done that numbers he ultimately multiplied with the 30,000 and he got it for overall. You can normally do like how we did in our Ind AS 109. And to be more honest and specific with you, these numbers you can match with one of our question in Ind AS 109 compound financial instrument. This will be the second question we have done in your class notes. You can go back and check, same numbers you will find. Okay, so this is your equity, this is your liability component. On which date? On the date of issue. But till now, after the date of issue till the date of transaction, in between how many years are there? 2 years are there. For this 2 years also accounting we have to do, no? So in this 2 years, equity balance nothing will change. Liability means you will apply ACM accounting, and by today this is the balancer, 30,27,666. So that much of liability should be there and this much of equity should be there. So if you add both of them, this is 31,85,000 plus 27, something around 32 lakhs odd you will have. But presently our carrying amount is 31,50,000. So excess amount has to be created, means more amount is required. See, in your balance sheet 31,50,000 is presently there. What I need is this should go away. So we'll kill this, we'll debit this liability account. In that place we'll create an equity component of 185,400. CFI financial liability we have to create 30,27,666. Gaap difference whatever is there, that came to here they printed 93,066. Please make it 63,066. So 63,066. This you have to adjust it to retained earnings. This question in the past they have carried on the wrong solution in the study material, but now they have rectified. Of course, a small error only is there. That is that. Sir, I hope you understand this. This is a sum with total retrospective. So, this is done. We got to document this one also. Please write this. Compound financial instruments. An entity need not split its CFI into equity and liability components if liability component is not outstanding on transition date. So this is the only, if any liability component is outstanding on date of transition Ind AS 109 to be applied retrospectively. So guys, this is the treatment you have to give for CFI. So copy this, sir. We'll move on to one good adjustment in business combination. With that, we are done with this. One joint venture related adjustment is there. Except for that, remaining questions are only there. Okay, chalo sir. Let's move. Yeah, business combinations exemption. Okay, sir. Business combination chapter we have covered. India's 103 sums and all we have finished. India's 103. In India's, you know, there is an acquisition method and all. In some exception cases, we do common control cases, we will do pooling of interest also, and there is a reverse acquisition discussion and all. Go back to AS 14 days. In accounting standard 14, you only had amalgamation in the nature of merger, amalgamation in the nature of purchase, and there is nothing called as a reverse acquisition and all. Moreover, just imagine, sir, you followed AS 40, you are an entity who is converting into Ind AS right now. In the past, you acquired some other entity. When you acquired that some other entity, you classified the amalgamation as amalgamation in the nature of merger, and you did pooling of interest accounting. Pooling of interest accounting means incorporate all the assets and liabilities at book value, that sort of thing. Now, you all very well know that in India's 103, pooling of interest method accounting is not there except for common control transaction. Normally, when one entity takes over another entity, you have to apply acquisition method. Acquisition method ka fundamental rule says that all the assets, all the liabilities must be incorporated at what value, sir? Fair values you have to incorporate, isn't it? That means you see how much of shift difference is there. Earlier, you have accounted some acquisition according to AS 14. But what is the treatment under India's 103 is completely in contrast to that. Now, if I say, now that you are migrating to Ind AS, apply Ind AS 103 retrospectively. Ind AS 103 retrospectively application means what, you know? This entity who is now migrating into Ind AS have to sit on the date of transition, think about all its past business combinations and how it has accounted them. Had this entity accounted all those acquisitions in accordance with Ind AS 103, today what would be the position in the balance sheet? That you have to reconstruct. You just imagine how difficult task it is. Suppose I'm a very big company, sir. I'm in existence in the last 40 years. In the last 40 years, I have done so many acquisitions, so many purchases I have done. All those have accounted in accordance with old Gaap, the normal accounting standards and all. And now I am asked to shift to Ind AS. I'm shifting, and on this shifting date, which is the transition date, if you ask me to go and apply Ind AS 103 retrospectively for all the transactions what I have done in the past, this is going to be very, 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 very difficult for the entity. So what exemption is given under this standard is Ind AS 101 says you can forget about the past. From hereafter in the sense from date of transition, all acquisitions must be accounted in accordance with Ind AS 103. In the past, whatever happened, we'll let it go. You need not restate it, simply forget about that. From hereafter, apply Ind AS 103. Just imagine, sir, indirectly, Ind AS 103 prospectively you can apply from the date of transaction. Okay, that means you may come and question, sir, in the past I accounted everything at book value, sir, when I took over B Limited. Doesn't matter, let it go, let it go. Or you may say, sir, in the past when acquisition happened, sir, I accounted and all, but after applying Ind AS 103, I realized that that is a reverse acquisition. I am the acquiree, that fellow is the acquirer, but in the absence of these provisions, I did normal accounting, but reverse acquisition accounting has to be done. Doesn't matter, leave it. Leave it. In the past, Ind AS 103 could not apply because you are in AS. Now on the date of transition, the standard gives you permission that you apply Ind AS 103 retrospectively. You need not go back, find out, do detailed investigation, not required. That's all. Now if you say, no sir, 2 years back, I acquired one business. I have all data relating to that. I will do retrospective accounting of Ind AS 103. You can do. If you want, you can do retrospective. You can look at this heading. This is an optional exemption. So if you say you want to apply Ind AS 103 retrospectively, nobody will stop you. But there is a small rider with that. What is that rider? If you want to do Ind AS 103 application with retrospective effect in respect of any acquisition, okay, you can apply that. But thereafter, all the acquisitions also have to be restated. I'll tell you with an example. Suppose this is your date of transition. Let's say 1/4/2010. On 1/4/2004, you acquired B Limited. Somewhere over here you acquired C Limited. Somewhere over here you acquired D Limited. Like that. 3 acquisitions are there. On this date, what Ind AS 101 says is, "Arey bhai chodo, whatever has happened has happened. From hereafter you apply Ind AS 103. This is a choice you have. Suppose you say, no, I will do 103 application retrospectively. Okay. Sir, from which date will I do retrospectively? Your choice. If you want to do voluntarily retrospective effect, you can do. Select a date. From that date, every business combination has to be restated in accordance with Ind AS 103. For example, you say, sir, C Limited acquisition is there, no sir. That I want to do Ind AS 103 application. Okay, you can do. But if you select C Limited acquisition to be restated as per Ind AS 103, then even D Limited also you have to do. In between, if E Limited is there, E Limited acquisition, that also you have to do as per Ind AS 103. Suppose you selected B Limited. So you say, sir, B Limited I want to do as per Ind AS 103. You can do B Limited, but you have to compulsorily do C, D, E also. Or sir, I will do it from E Limited, sir. Then fine. E Limited onwards you restate. B, C, D you can forget. You need not do any retrospective restatement. So all in all, simply put, the adjustment is this. Ind AS 103 business combination standard can be applied prospectively from the date of transition. That's it. If you want to do retrospective restatement as per Ind AS 103 or retrospective application of Ind AS 103, you can do that. But once you select a date, thereafter all the business combinations have to be accounted under Ind AS 103. So that is that. Okay. I'll make you write that. So let's read what is given there. Ind AS 103 need not be applied to business combination before the date of transition. But if one business combination is restated to comply with Ind AS 103, all subsequent business combinations are to be restated. That's all. Now, there are a lot of paragraph story they have summarized into a small table. The table is a very good table. Anyway, let's see case by case. Case 1. Is there an asset liability recognized in the previous Gaap? No. And in Ind AS also no extra asset, no extra liability needs to be recognized. Then there is no adjustment you have to do. For example, sir, I have acquired some entity in the past. When I acquired some entity in the past, I have recognized one asset, asset or liability, or I have and this Ind AS says such asset or liability should not be recognized at all. Okay, or I have not recognized one asset or liability in the past, but this Ind AS says no, you have to recognize an asset or liability. In that case, what to do? That discussion we are doing. Situation 1 is a hypothetical situation, sir, where there is no a dispute between what I have done and what has to be done as per Ind AS. A case you leave it. Let's discuss dispute cases. Dispute cases means, carefully understand. In the past, I have taken over an entity. So their assets and liabilities are incorporated. One intangible asset I did not recognize. This Ind AS, because at that time AS 26, according to AS 26, does not qualify or something. Let's take the case of a research in progress asset. So AS26 did not permit me, so I did not recognize. But according to India's 103, you can recognize a research work in progress as a asset on the date of acquisition. So now I have to recognize that. Or another example, there is a PP in that fellow's company, in that Aquarius company, which I did not recognize or which I have recognized, but India says such asset should not be recognized. Examples. So in this case, how will you account for those assets or liabilities on the date of transition? See, you must understand, I am not asking you to restate everything with India's 103 effect and all, but some assets and liabilities which you should have recognized as per India's, but you did not recognize in the past. Such assets and liabilities you have to recognize on the date of transition. Or you have recognized some assets or liabilities in the past, but they are not to be there in your balance sheet, then you have to remove them on the transition date. Okay, so this much is there. See, I have given you exemption from what? From applying India's 103 retrospectively. That exemption is there, but in the past you have recognized something as an asset which is not an asset at all as per India's. We cannot let it carry forward. You have to kill that. Similarly, a research asset is there in the acquired entity. You never recognize it that as an asset. Now you have to recognize it. Okay, so asset liabilities, if whatever has to be there or whatever should not be there as per India's, that much has to be followed on transition date. You need not do retrospective accounting and all, but one thing is clear, assets and liabilities on the transition date must be as per India's. If in the past you have not recognized something under AS, but it has to be there as per India's, recognize it now. In the past you have recognized something under AS, but that's not acceptable under India's, kill them right now. That's all, sir. Now, a table is about when you recognize an asset or liability right now, or you have to de-recognize an asset or liability right now, where will you give the corresponding effect? So you must understand, if I tell you create an asset in the balance sheet on the transition date, you will create an asset. Asset is a debit balance. Where will you give the credit? Or if I ask you create a liability today, I will create a liability in respect of some acquisition in the past. Where will you correspond? Where will you give the corresponding debit? That discussion is happening in this table now. Now for this we have a universal answer. What is that? What is there, sir, on transition date? Whatever adjustments are there, correspondingly we have to impact what? Retained earnings only, no? Correct. You have to correspondingly give impact to retained earnings only. But one exception is there. That exception is, carefully listen. You recognize a new asset, you remove an asset. Or you recognize a new liability, or you remove a liability. Correspondingly, effects must be given to retained earnings, except when you are recognizing an intangible asset or de-recognizing an intangible asset. If intangible asset related adjustments are happening, then corresponding effect should not go to retained earnings. It should be adjusted against goodwill capital reserve. So general principle holds good, sir, but there is an exception. What is the general principle? Any adjustments, asset you create, asset you remove, liability you create, liability you remove. Balance sheet only this much can happen, no. When this happens, corresponding impact you give it to retained earnings. Either increase retained earnings, decrease retained earnings, whatever is required, do that. Exception is already existing intangible asset if you are removing, or you are now recognizing a new intangible asset. In two cases, corresponding effect must be given to goodwill / capital reserve. Rest all cases you have to give it to retained earnings. That's all is there in the table. Let's read the table. If you want logic, I'll tell you, but if you have listened to all the standards correctly by now, you should have understood. Case 2 I'm reading, sir. There is no asset or liability recognized in the past, but there is an asset or liability that requires to be recognized in India's. Is it an intangible asset? No. If it is not an intangible asset, all changes must be passed through retained earnings. Now come to case 5. There is an asset or liability as per past AS, but as per India's it should not be there. It is not an intangible asset. Therefore, corresponding effect should be given to retained earnings. Case 3. In the past there is no asset liability, but now an asset has to be recognized, and that asset happens to be an intangible asset. In that case, you will recognize the asset, but adjustment has to be given to goodwill. Similarly, in the past there is an asset, but that asset you should be removing it right now. And if such asset happens to be an intangible asset, then you will remove it. Of course, you will not recognize it now. Corresponding effect must be given to goodwill. Sir, why sir intangible asset ki goodwill impact or goodwill capital reserve impact, why should we give towards goodwill capital reserve? For that, the answer is very simple, sir. Suppose A1, A2 to L1 to L2 to business purchase. This is the incorporation entry I am writing. Okay, randomly let me write some numbers. 100, 200, 50, 50. So, as you can see, 200 plus 300 minus 200, let us say 350 is the PCMP, or let's say 250 is the PCMP. As you can see, 50 rupees balancing figure will come. That we will transfer it to goodwill. Now I tell you, this selling company whose assets and liabilities I am incorporating now, that selling company has got a research asset worth 10. According to AS 14, there is no specific principle and research work in progress is not treated as an asset at all. So I would not recognize that. When I don't recognize, what will happen is this differential 50 will automatically go and sit in the name of goodwill. Sir, did I take the research work in progress? Yes, I took. But did I call it as a separate asset in the balance sheet? No, it's subsumed into the goodwill. It's adjusted into the goodwill, right? Suppose on the date of transition, I tell you, no sir, research asset you have to show separately. Okay, after some 1 year, 2 years, when transition date has occurred, research work in progress worth 10 I have created. Now credit where? On the original date only, had you allowed me to recognize research WIP as an asset, what I would have done? Here I would have recognized research work in progress. Then, had I recognized this, this would have been 40 and not 50. So therefore, goodwill you have to adjust. That's the only reason, sir. The same applies in the case of derecognition. You have recognized some intangible asset. Because of that, obviously on the acquisition date, your goodwill amount would have changed. Now if you say such intangible asset should not have been recognized, so remove the intangible asset, automatically goodwill amount will increase. So you will correspondingly impact goodwill or capital reserve when it is because of an intangible asset. In all other cases, you are not supposed to touch the goodwill capital reserve because you are not disturbing any assets and liabilities, so let it stay like that. Okay, in every other adjustment you have to go through retained earnings only. So let's read this. If an asset acquired or liability assumed was not recognized in the previous Gaap but would have been recognized in Ind AS, it shall not have a deemed cost of 0 and shall be measured at the amount at which Ind AS would require it to be measured. The resulting change is recognized in retained earnings. So what is he trying to say is, if an asset or liability is not measured in the past, but Ind AS says such an asset or liability should be there as on today, so on the date of transition you have to recognize such asset or liability. Corresponding effect you give it to retained earnings. Sir, at what value, sir? At such value which Ind AS requires, means corresponding Ind AS. So generally, business combination we are talking about, you must be recognizing them at the fair value only. If an asset or liability assumed was recognized in the previous Gaap, but Ind AS would require its subsequent measurement at other than original cost, it shall be measured at such basis and not at its original cost. In the past you have recognized at some value, but according to Ind AS, the measurement is not acceptable, then you will change the measurement and corresponding adjustment must be given in the retained earnings. In all other cases, no measurement adjustment shall be made to the carrying amount of the assets acquired and liabilities issued. Okay. Therefore, it should be evident that the balance of goodwill or capital reserve as per previous Gaap is not adjusted. You are not supposed to touch goodwill or capital reserve, except for the two reasons what we already discussed. Recognition of intangible asset that was earlier subsumed in the goodwill or capital reserve, but Ind AS requires it to be recognized separately, or vice versa. Vice versa is what? Derecognition of an intangible asset. Sir, illustration 5 is not actually an application of what we have studied. This is a new point in this, so carefully read. A Limited has made certain investments in B Limited's convertible debt instruments. So A has invested in the convertible debt of B. The conversion rights are substantive rights. and would provide A Limited with a control over B Limited. So I'm not an equity shareholder, I'm a convertible debt investor, but these conversion rates are substantive, means they are realistic alternative of happening and they are likely to give us control there. A Limited has evaluated that B Limited would be treated as its subsidiary under Ind AS and hence would require consolidation in its Ind AS consolidated financial statements. So fine, when control is there, consolidation you have to do. B Limited was not considered as a subsidiary, associate or joint venture under previous Gaap. Okay. How should B Limited be consolidated on transition to Ind AS, assuming that A Limited has opted to avail the exemption from retrospective restatement of past business combinations? The question is, A Limited is holding convertible debt instruments in B Limited in the past. According to Ind AS, even convertible debt instruments are capable of giving you control if the conversion rates are substantive and all. And therefore, such B Limited is my subsidiary and I have to apply Ind AS 110 and do consolidation today. But earlier, without Ind AS, when A Limited was applying AS, B Limited was never regarded as subsidiary only, consolidation only was not done in the past. And now, how should B Limited be consolidated on transition to Ind AS, assuming that A Limited has opted to avail the exemption from retrospective restatement of past business combination? So you see, observe now, in the past, AS 14, we never treated it as a business combination only and therefore consolidation never happened. But on the date of transition, you realized that B Limited is your subsidiary and you got to prepare consolidated financial statements right now. Now, how will you do this? Now, practically, you see, forget about the exemption. Normally, if I ask to apply Ind AS retrospectively, what you should do? What you should do is, from the date of acquisition, when you acquired that controlling power in B Limited, on that day onwards, which is treated as a date of acquisition, had you prepared consolidated financial statements year after year, year after year, year after year, today, what will be the consolidated financial statements position as on today that you have to draft? Correct? No, so that is the original retrospective treatment. But here, Ind AS 101 gives a small relaxation here. Now, what is that relaxation? We'll read further. Ind AS 101 prescribes an optional exemption from retrospective restatement in relation to past business combinations. Ind AS 101 prescribes that when the past business combinations are not restated and the parent entity had not consolidated an entity as subsidiary in accordance with previous Gaap, then the subsidiary's assets and liabilities would be included in the parent's opening consolidated financial statements at such values as would appear in the subsidiary's separate financial statements if the subsidiary were to adopt the Ind AS at the parent's date of transition. Sir, what is that big sentence, sir? Nothing, sir. Whatever happened in the past, forget about that. Now today, let's say 1/4/2016, or let's say 2019. This is your date of transition. Okay. You are, let us say, A Limited. You anyway have to follow Ind AS from this date onwards. What you do is, you are a first time adopter. What you do is, on the same date, B Limited, your subsidiary, ask them to prepare a financial statements as if they also have to follow Ind AS. So even this also will become the date of transition for them, for the subsidiary. Prepare a financial statements. These financial statements you consolidate with A Limited. That means whatever is your date of transition, assume that also is the date of transition from this for your subsidiary. Ask them to prepare a financial statements. They can also apply Ind AS 101 relaxations and all. They can enjoy everything. Get a financial statements from them and then do consolidation. For this purpose, the subsidiary's separate financial statements would be prepared as if it was a first time adopter of Ind AS. That is, after applying all the relevant first time adoption, mandatory exceptions and voluntary exemptions. In other words, the parent will adjust the carrying amount of subsidiaries' assets and liabilities to the amounts that Ind AS would require in the subsidiary's balance sheet. That means all the adjustments and all Ind AS 101 applications you do in subsidiary financial statements also. For you, you are anyway doing, even for subsidiary also you do, and then prepare a balance sheet on the date of transition for the subsidiary also, then do the consolidation. Look at this. The deemed cost of goodwill equals the difference at the date of transition. See how to compute a goodwill that we already have learned in India's while doing India's 110 or India's 103 and all. Normally goodwill, when will you compute? On acquisition date you will compute, correct? No? But you see here, they are telling you, procedure is same only, but you are, when are you doing? On the date of transition you are doing. See, carefully understand. I am A Limited. Forget about consolidation. A Limited, SFS you prepare. B Limited, SFS you prepare. B Limited's financial statements under India's on the date of transition. Now books investment will be there, investment in subsidiary. Investment should go and all those assets and liabilities should come, NCI should come on the date of transition. Normally date of acquisition I would have told you, but in the past since I never did that, forget about past. As on today, date of transition ki you do. What are you doing, sir? From your SFS, investment will disappear. Subsidiary ka assets and liabilities will come in, NCI will come. The difference whatever is there, that difference you go and park it into goodwill or capital reserve. That's all. The parent's interest in adjusted carrying amount. That means assets and liabilities are coming, the net assets of subsidiary is coming, our net assets no your shareholding. So 70%. 70% to 80% of whatever is there, that much. Our remaining 20-30 is only NCA. Okay. And the cost in the parent's SFS of its investment in subsidiary. This is nothing but our share of net assets versus cost of investment. These two are difference whatever is there, that difference you identify it as goodwill or capital reserve. Sir, where is sir, subsidiary anyway has to follow India's because parent is following India's. Subsidiary also will prepare India's balance sheet. I will also prepare India's balance sheet. Let's consolidate. Where is exemption? This can't you see the exemption? The exemption is what? Instead of doing it on the date of acquisition, we are asking you to do it on the date of transition. So whatever assets and liabilities you incorporated today, in that your share you work out. A remaining share is minority. Forget about that. And investment in subsidiary, whatever you are removing, investment gone ki our share of net assets which are coming, a gap whatever is there, that you go and identify it as goodwill. This is nothing but you working out goodwill based on PSN on date of not acquisition, transition. So this is the adjustment set. Next, come to sixth question. Come to the next case. A Limited has a subsidiary B Limited. On first time adoption of India's by B Limited, so A and B again same. A Limited is parent, B Limited is subsidiary. On first time adoption of India's by B Limited, it availed the optional exemption of not restating its past business combinations. Fine. However, A Limited in its consolidated financial statements has decided to restate all its past business combinations. Whether the amounts recorded by subsidiary need to be adjusted while preparing the consolidated financial statements of A Limited, considering that A Limited does not avail the business combination exemption. Will the answer be different if A Limited adopts Ind AS after B Limited? Oh. Anyway, A, B, parent subsidiary, past business combinations of A Limited. These are past business combinations of B Limited. B Limited said, I want to select the optional exemption of not restating my past business combinations. I will apply Ind AS 103 prospectively. A Limited says, in my financial statements, I don't want that exemption. I will apply Ind AS 103 retrospectively. All my past also I am going to restate it. Sir, can they do like that? Obviously, individually entities can do whatever option they want to select. But the question is not that, no. Whether the amounts recorded by subsidiary means whatever existing carrying amounts are there in the past that they have brought forward as it is without restating by selecting the exemption. Do they need to be adjusted while preparing the consolidated financial statements of A Limited? So, in consolidated financial statements on the date of transition, A Limited their own financial statements, they have restated in accordance with India's 103 retrospectively. B Limited fellow, they did not do. That fellow did not do. So consolidation law, can I accept B Limited's financials as it is, or should I ask them to restate? The answer is very simple, sir. Consolidated financial statements are prepared as if this group itself is a single entity. That means you will not see A and B separately. If A and B together are a single entity, how the financial statements will appear, that only is a consolidated financial statement. So you have to compulsorily restate all the past business combinations. It's not like you have to restate. Whatever parent has followed, subsidiary also has to follow the same for the purpose of consolidated financial statements. Standalone A Limited and B Limited can have different exemptions, but while doing consolidated financial statements, this group itself is treated as a single entity. When I'm saying that you group people are a single entity, how can you say in our group one division has taken exemption, another division has not taken exemption? That is invalid statement in the first place, isn't it? So while doing consolidated financial statements, if parent and subsidiary both have got different exemptions, you have to definitely restate subsidiaries exemption, subsidiaries financial statements in accordance with parent. That is it. There is another question here. Will the answer be different if A Limited adopts Ind AS after B Limited? That means subsidiary has first applied Ind AS and parent has applied Ind AS from a later date. Sir, how is it possible, sir? Roadmap law, you told that when subsidiary gets attracted for Ind AS, its parent automatically comes under Ind AS and vice versa, isn't it? So how is it possible that subsidiary applies Ind AS first but parent applies Ind AS later? How is it possible? This exception also in roadmap story only I told you. What is this? Imagine if the parent or subsidiary, one of that fellow is a NBFC. If one of the guys is an NBFCs and all, they have a cut-off date before which they cannot apply Ind AS. So in that case, imagine the parent is an NBFC. So parent cannot apply Ind AS before a particular date, whereas subsidiary can follow applying Ind AS. In these cases, what should I do? That is a question. In this case, Ind AS has given a small, Ind AS 101 has given a small exemption for you. What is that is? Okay, anyway, the first answer is this, sir. If A Limited restates past business combination, it would have to be applied to all the business combinations of the group, including those by subsidiary B Limited for the purpose of consolidated financial statements. That's first part. Ind AS 101 states, however, if the entity becomes a first-time adopter later than its subsidiary, the entity shall, in its consolidated financial statements, measure the assets and liabilities of the subsidiary of the same carrying amount as in the financial statements of subsidiary, after adjusting for consolidation, equity adjustments, and for the effects of business combination which the entity acquired the subsidiary. That means, in a simple words, subsidiary started applying Ind AS first. Imagine they have taken the exemption. So they never restated any past business combination. Later on, parent company also started applying Ind AS. Now that parent company also started applying Ind AS, the parent company will do consolidation as per Ind AS also. For the purpose of consolidation, A Limited said, in their standalone, A Limited said, all my past I am going to restate. Okay, let them restate. But for the purpose of consolidation, B Limited also I am going to bring and incorporate into my books now for the purpose of consolidation. At that time, relaxation is there. What is that relaxation? B Limited's past, you are not supposed to restate. Whatever carrying amounts are there, you can as it is take up from that. B Limited financial statements, so whatever assets and liabilities are appearing at whatever carrying amounts, you have to incorporate that as it is. You need not do any restatement of past. So when is the exemption available, sir? When is the relaxation available for you in case of consolidation? When parent applies Ind AS at a later date than the subsidiary, then exemption is applicable for not restating past business combinations. Quite deep, but it's not very difficult. Sir, so this is about business combinations. So we'll make notes on this. 7. This question, what we have done towards end, that question looks like a good question, sir, from an examination perspective as well. Ind AS 103 need not be applied to business combinations before the date of transition. But if one business combination is restated to comply with Ind AS 103, all subsequent business combinations have to be restated. If any asset or liability was not recognized as per previous Gaap, but would have been recognized as per Ind AS, then recognize such asset or liability as per Ind AS values by adjusting against retained earnings. For this exception is that is the intangible asset one. That exception will make you right. Similarly, if any asset or liability was recognized as per previous Gaap, but would not have been recognized as per Ind AS, then eliminate such asset oblique liability by adjusting against retained earnings. The adjustment shall not be made to retained earnings if it relates to recognition or elimination of intangible asset, in which case it has to be adjusted against goodwill capital. So this is the example. Sir, if you copy this, there is only one more thing, sir, relating to joint venture, that while doing the sum correspondingly I will explain, and then we will make notes on that. So that's all, sir. That's all the important ones are over except for the joint venture one. Towards the end I have to show you something. Yeah, presentation and disclosure requirements. So of course this is comparatives you have to give. Obviously we will give the comparatives in accordance with the Ind AS. You must give reconciliation of equity from previous Gaap to Ind AS at transition and last year ending. What it means is, in the past Gaap, what was the equity? On the transition date balance sheet, what is the equity? From that equity to this equity, entire reconciliation statement has to be given. Example, I'll tell you. As per AS, when you say heading of equity, shareholder funds, reserves and surplus, money received against share warrants used to be there, right? In that share capital, you used to include even preference share capital also, as per old Gaap, Schedule 3 Division 1. But this Ind AS, as per Ind AS, preference share capital most likely is going to be a liability. So we'll remove that, correct? No? Similarly, our reserves and surpluses, so many adjustments will be made now, because every time you apply Ind AS retrospective or to make any adjustments, there corresponding effects will be coming to retained earnings only, no, because of that reserves and surplus amount, what was there on 31st March, what is there on 1st April, there will be a change, because 31st March balance sheet is prepared as per AS, whereas on 1/4 transition date we are preparing as per Ind AS. You might have taken some exemptions, alright, but there might be some changes between the reserves on the previous day and the reserves on the next day morning, because you are doing Ind AS adjustments there. So entire reconciliation you have to give. On that reconciliation also one sum is there. Anyway, sir, come to illustration 16. Illustration 16 is due, sir. Illustration exam case due. Even illustration 17 is also due. 17 is a new question that's added in the book, but this is due. On the back side also, they have added some 4 or 5 questions. In that 1 or 2 questions are good ones, rest are basic level questions. Anyway, let's first finish this off. Don't worry from the size of the question, sir. It's going to be very simple. Just pay attention. H Limited has the following assets and liabilities at 31st March prepared in accordance with the previous Gaap. Okay, previous Gaap, sir. Careful. This is not as per Ind AS. PPE 134,50,000. Note point 1 is there. That we will read later on. Investment in S Limited looks like a subsidiary. 48 lakhs. Trade receivables. Advance for purchase of inventory, cash, total assets, VAT deferral loan, note point 3 we have to read, creditors, short-term borrowings, provisions, total liabilities, share capital, reserves, cumulative translation difference, ESOP reserve, SBB reserve, retained earnings are there, total equity, equity and liability. That's fine. The following gap differences were identified by the company on first time adoption of Ind AS with effect from 1st April 2001. You must understand this as a transition in this case. Note point 1, sir, he is talking about PP. PP amount is this. Now read the note point 1. In relation to PP, the following adjustments were identified. PP comprises land held for capital appreciation purposes costing rupees 4,50,000 and was classified as investment property as per Ind AS 40. Obviously, land held for capital appreciation is a IP. It should not be grouped under the heading of PP. So, in your 134,50,000 total amount, 4,50,000 you should remove from there and you should call it separately as an investment property. That is one adjustment. This is a grouping adjustment, easy only. Next, exchange differences of rupees 1 lakh were capitalized to depreciable property, plant and equipment, of which a cumulative depreciation of 40,000 was recognized. Means in your 134,50,000 whatever amount is there, in that some PPs are there, machineries and all, towards which you capitalized exchange losses. Sir, how can we capitalize exchange losses? You must understand AS 11 permits paragraph 46-46A. So in respect of that, 1 lakh of exchange difference which normally should go to PRL or P&L account, it got adjusted into asset cost. But even though 1 lakh got adjusted, out of that 1,40,000 already has been written off to P&L account in the name of depreciation. So effectively, how much exchange differences is still existing in your PP and 60,000 is the answer for that. Sir, now what I should do? What you should do if you are, see, it depends. No, sir, PP, what you should do means you have 3 choices. You apply Ind AS 16 retrospectively. If you do that, you have to remove this 60,000. No, sir, I want to do fair valuation the transition date. If you do fair valuation of the entire asset, that is one way. Or third option, whatever carrying amount is there as per old Gaap, as it is, you can bring it on into Ind AS. You can do that, right? Deemed cost exemption is there. So if you select that, then the 60,000 will be there in that only. I am not going to touch that. There were no asset retirement obligations. What is the meaning of asset retirement obligation is provision for decommissioning and all. It is not there in his telling. That's okay. The management intends to adopt deemed cost exemption for using the previous Gaap carrying values as a deemed cost at the date of transition for PP and investment property. With this, what has happened is whatever exchange difference 60,000 is there in the asset, we are not going to touch that. Let it be there. Let it be there because they are selecting deemed cost option, right? So overall summary, sir, in respect of this 134,50,000, what you got to do? Nothing you have to do. A 4,50,000 amount you separate and call it as investment property. Rest of it is PP. There is no adjustment required. Note point 2. Note point 2 is regarding investment in subsidiaries, sir, which is appearing here at 48 lakhs. That's what adjustment is there. The company has made investment in S Limited subsidiary for 48 lakhs that carried a fair value of 68 lakhs on the transition date. The company intends to recognize the investment at its fair value on the date of transition. Do they have the choice? You go back and see, in respect of investment in subsidiary, associate and joint venture, cost as per Ind AS 27, fair value on the date of transition or the previous Gaap carrying amount. Previous Gaap carrying amount in this example was 48 lakhs, but if they want, they can also do fair value on the date of transition and they want to do that, let them do. So, this 48 lakhs on the transition date balance sheet, which is the next day only, from 48 you have to jump it to 68. So 20 lakhs asset increase correspondingly, where will you adjust? Where will you adjust? Equity level adjust. Reserves and surplus retained earnings is there. There you go and adjust. Next, note point 3 is regarding VAT deferral loan. Let's see what is that. Looks like a big paragraph. Anyway, let's see. The VAT deferral loan of rupees 60 lakhs was obtained on 31st March 2001 for setting up. Oh, wait there. Was obtained on 31st March 2001. When is 31st March 2001? E-balance sheet date only. Just today only you obtained. Or if I am standing on the transition date, yesterday we have obtained. For setting up a business in backward region with a condition to create certain defined targets for employment of local population of that region. Okay. The loan does not carry any interest and is repayable in full at the end of 5 years. So concessional interest rate loan basically. In accordance with Ind AS 109, the discount factor of the loan is to be taken as 10%, being the incremental borrowing rate. Accordingly, the fair value of the loan on 31st March is rupees 37,25,528. Out of 60 lakhs, 37 lakh rupees is treated as the loan component. The entity chooses to exercise the option given in paragraph B11 of Ind AS 101. That is, the entity chooses to apply the requirements of Ind AS 109 and 20 retrospectively as the required information has been obtained at the time of initially accounting for VAT deferral loan. Anyway, let me put it very straightforward to you. In case of government loans or concessional interest rate loans, the discussion in Ind AS 101 is you are not supposed to do any splitting of grant component and all. Whatever liability is there, whatever remaining future payments are there, match them, find out an EIR and do prospective accounting as per Ind AS 109. You are not supposed to identify grant component. Point number 1. Point number 2 is, no sir, I want to apply Ind AS 20, I will identify grant component retrospectively. You can do that. You can do that, provided whatever information you need for splitting up the grant component and all, that you must have obtained on the date of obtaining the loan itself. Correct? So this fellow wants to obtain, this fellow wants to apply retrospective accounting of Ind AS 20 and all because he has all the information. Now you see, why is he having all the information? He's standing today on the transition date. Loan was obtained yesterday only. So obviously information is that today information in the market you can take and you can split. Accordingly, you do not do the work. The fellow already split. So loan amount is 37,25,528. So out of your 60 lakhs amount received, 37 lakhs is the fair value. The remaining 22 lakhs chiller or 23 lakhs chiller, that will become your grant component. So accordingly, you will split it. 60 lakhs, two parts you make. One you retain it in liability, the amount, the remaining grant component, you show it as deferred income. Next, note point 4. Let's see, note point 4 is regarding this reserves, these two reserves. Okay. The retained earnings of the company contained the following. ESOP reserve of 20,000. The company has granted 1,000 options to employees, out of which 800 have already vested. Okay. So 1,000 options to 800 options already vested. The company followed intrinsic value method for recognition of ESOP charge and recognized 12,000 for vested options and 8,000 over a period of time as ESOP charge and a corresponding reserve. So he is giving you breakup, sir. 20,000 SBP reserve, whatever you have, in that 12,000 is relating to vested options, 8,000 is relating to unvested options, and he is very clearly telling you this fellow has measured options on the basis of intrinsic value and not on the basis of fair value. If fair value method had been followed in accordance with 102, the corresponding charge would have been 15,000 and 9,000 for vested and unvested respectively. In place of 12, you should have had 15. In place of 8, you should have 9,000 had you applied 102. Okay, the company intends to avail Ind AS 101 exemption for share-based payments for not restating the ESOP charge for vested options. So you must remember, what is the option exemption available? If it is vested option, then if you want, you can forget about Ind AS 102. Whatever you have done, you can stay put with that. Or if you want, you can also restate. But for unvested options, you compulsorily have to apply retrospectively. Now this fellow wants to take the exemption, let him take the exemption. So what you have to do? At 20,000, 12,000 is one component, 8,000 is one component. 12,000 relates to vested options. Forget about that. At 12,000 will stay like that only. You need not make 12,000 into 15,000. Forget that. That is an exemption. Whereas the 8,000 which relates to unvested options, that definitely you have to apply Ind AS 102 retrospectively, which means that 8,000 has to be now made to 9,000. So how much increase in the obligation? 1,000 rupees. Corresponding debit of that will be given to retained earnings. Next, cumulative translation difference. Rupees 1 lakh, the company had a non-integral foreign branch in accordance with AS 11 and has recognized a balance of rupees 1 lakh as a part of reserves. On the first time adoption, the company intends to avail 101 exemption of resetting the cumulative translation difference to 0. So FCTR 1 lakh is there, that FCTR they want to kill and make it to 0. What is your kill FCTR 1 lakh? Also add it to your retained earnings. That's all. That's all. So what is he asking? Prepare a transition date Ind AS balance sheet showing adjustments to the value of assets and liabilities. So note point 1 is regarding PP. In that only one adjustment is there. What is that? 4,50,000. Remove and call it as IP. One adjustment. Impact on retained earnings 0 because it's a grouping change. Number 2. Investment in subsidiary S Limited. It was appearing at 48. Now you make it 68. 20 lakhs increase is there on the asset side. Correspondingly, retained earnings also will increase by 20 lakhs. Second adjustment. Third adjustment. You have a loan appearing at 60 lakhs. The loan, you will split it into financial liability component and deferred income component. Amounts already given. Financial liability component they have given 37, 25, 5, 28. The remainder will automatically become the deferred income component, grant component. Next. Regarding ESOP reserve, which is appearing now at 20,000, it will become 21,000. Extra 1,000 debit you have to give it to retained earnings. Cumulative translation difference already appearing at 1 lakh, that will become 0. The FCTR you merge it into retained earnings and kill FCTR. That's all, sir. You do all these adjustments. Whatever we have discussed in note point, each one small point you can write. You can see 20 lakhs is the balance given in the balance sheet. Minus 1,000 for extra SBP reserve. FCTR 1 lakh you have added. And 20 lakhs subsidiary investment has increased, that you have added. So the total change or total increase in retained earnings is 20 lakh 99,000. To whatever retained earnings existing is there, to that 20 lakh 99,000 if you add, closing balance will come off. Final balance sheet, since you are preparing India's balance sheet, division 2 format you should present obviously. But for this you must remember division 3 balance sheets are initial sessions we have completed this, so you must be knowing that. Okay, chalo, come to question number 17. Shaurya Limited is the company having a registered and corporate office at New Delhi. 60% of Shaurya Limited shares are held by Government of India and rest by other investors. So 60%, okay, it's a kind of government company. This is the first time Shaurya would be applying India's for the preparation of its financials for the current financial year 1920. Okay. Following balance sheet is prepared as per earlier Gaap at the beginning of preceding period. The beginning of preceding period itself means it is a date of transition with additional information. The date of transition balance sheet, but as per earlier Gaap. Obviously you know your job. What is our job? Convert this into India's. Date same as sir, but you have to convert this into India's. Okay, he wrote 31st March 18, we may call it as 1419 and we will do. So shareholder funds, non-current liabilities are there, deferred tax liabilities there, current liabilities are there, non-current assets, so PP, intangibles, goodwill, non-current investments, long-term loans, other non-current assets, current assets also it's full. Okay, good. Okay, sir, sum looks little lengthy, but very easy sum, sir. Okay. Okay, just to calm down you a bit and tell you. Additional information, if you see, 1, 2, 3, 4, 5 points are there. After that, A, B, C, D, E, F, G, H points are there. These 1, 2, 3, 4, 5 points, whatever are there, these 1, 2, 3, 4, 5 points are grouping errors. Grouping error means something sitting in current asset or other current assets. You have to group it into some other place. Something sitting under the heading of long-term borrowings, you have to remove from there and put it in some other place. So items number 1, 2, 3, 4, 5, they don't have any numerical adjustments and all. You just simply have to do a grouping error, means balance sheet look grouping, correct heading, subheading, so you have to group, that's all. Whereas from A, B, C, D, there are some adjustments and all in that. Okay, let's read now. Other current liabilities include, wait there, other current liabilities means this one. The first note point is regarding this. Other current liabilities include rupees 3,90,000 liabilities to be paid in cash, such as expense payable, salary payable, etc. And rupees 60,000 are statutory government dues. Okay, 390, 60. Total is how much? 4,50,000. Okay. Now, sir, what is the problem, sir? You have to pay 390, you have to pay 60. So total 450. It's you have to pay. Therefore, it's a current liability. Other current liabilities, so we group. What is the problem? You must understand. This balance sheet is not in accordance with India's, first of all. It is with your Division 1 Schedule 3 balance sheet, but not Division 2. Division 2, you remember, the moment you put non-current liabilities or current liabilities heading, first financial liabilities and heading will be there. Borrowings and all will go generally into financial liabilities heading. Like that in current liability also financial liability heading will be there. Under financial liabilities, short-term borrowings will be there, trade payables will be there, other financial liabilities will be there. If I know have a salary payable in cash, an expense payable in cash, they are all financial liabilities because they are contractually we are having obligations. How can you group it under other current liabilities? You have to group it under other financial liabilities. In India's Division 2 balance sheet, current liabilities low, you have financial liabilities, you have current tax liabilities, you have provisions, you have other current liabilities. When you know that salary payable and all are financial liabilities, under financial liabilities again subheadings are there, there you have to group and not under general residuary head of OCL. So that's a mistake. Sir, even this 60,000 also you have to pay in cash only. No, there's a government due. Government dues are not contractual obligation, no, statutory obligations. Government obligations and all cannot become financial liabilities. So 60,000 will stay there only under the heading of other current liabilities. 3,90,000 you have to group it under other financial liabilities. That's the adjustment. Next, long-term loans and advances include rupees 40,000 loan and the remaining consists of advance to staff of rupees 1,10,000. So let's see, loans and advances. This one. Note point 2 is regarding this. You can mark the numbers so that it will be easy for you later on while referring. Long-term loans and advances 1,50,000 low, 40,000 rupees represent real actual loan. The remaining is staff advances 1,10,000. Let's see what adjustment has to be done for that. Next. Now what type of loan and all he is going to explain it later on. Other non-current assets of rupees 2 lakhs includes capital advances to suppliers. It is other non-current assets. Okay, this one. For machinery and all you have given advances. Okay. Other current assets include 3,50,000 current assets receivable in cash and prepaid expenses of rupees 50,000. So other current assets is note point 4. Where total amount is 4 lakhs, the 4 lakhs from 3,50,000 receivable in cash. When something is receivable in cash, you have a right to receive cash. Generally, this will become a financial asset. It has to be grouped under financial asset. Prepaid expenses will stay there only under other current assets, no problem. Next, short-term provisions include dividend payable of rupees 2 lakhs. Wait there. So this one. This is note point 5. Or 12 lakhs, no? 2 lakh rupees dividend payable is there. The dividend payable had been as a result of board meeting wherein the declaration of dividend for the financial year 2017-18 was made. Wait a moment. Yeah. For this current year board meeting, no, they have declared dividend. However, it is subject to approval of shareholders in the annual general meeting. That means whatever dividend board has resolved, that is not final, that's not interim dividend and all, that's a final dividend. It's subject to approval of shareholders in the AGM, which means indirectly it is a proposed dividend. What is the mistake they have done? They created a provision for proposed dividend. You are not supposed to create a provision for proposed dividend. Dividend ka liability should be created only when dividend is properly declared. Board declaration is not sufficient in this case. Therefore, they should not have created any provision at all. So what you have to do is you have to reverse it. Basically, there is a mistake that will adjust it. Next, CFO of Shaurya Limited has also presented the following information against corresponding relevant items in the balance sheet. Okay, first one is PP. PP consists a class of assets as office buildings whose carrying amount is 10 lakhs. Okay, wait a moment, sir. I will show you. This is PP. This one, 20 lakhs. The 20 lakhs, so 10 lakhs is office building, sir, whose amount is 10 lakhs, whose carrying amount is 10 lakhs. However, the fair value of the office building as on the transition date is estimated to be 15 lakhs. The company wants to follow revaluation model as its accounting policy in respect of its PP for its first annual India's financial statements. So what do they want to do? From the 10 lakhs carrying amount, they want to update it to 15 lakh rupees. Sir, can I do that, sir? Of course you can do. On the transition date, you have three options. Apply Ind AS retrospectively, do fair valuation, or carrying amount as it is you bring forward. Correct? So in respect of this 10 lakhs office buildings, They want to do fair valuation. Most welcome. All you have to do is add 5 lakhs. Yeah. Next. The fair value of intangible assets as on the transition date is estimated to be rupees 2,50,000. However, the management is reluctant to incorporate the fair value changes in the books of account. They don't want to do fair valuation for intangible assets. So tell me, is it compulsory that you have to do fair value? No, it's an option. 3 options are one of the option. They don't want to do it, seems. So here the answer is do nothing. Continue the carrying amount. Next. Shaurya Limited has acquired 80% shares in a company. That means it's a subsidiary. Excel Private Limited few years ago, thereby acquiring the control upon it at that time. Shaurya recognized goodwill as per erstwhile accounting standards by accounting the excess of consideration paid over the net assets acquired at the date of acquisition. So in the past they have done some accounting for that as per existing accounting standards. Fair value exercise was not done at the time of acquisition. That means what is it trying to tell you is earlier when acquisition happened, accounting has done as per previous Gaap. At that time, as per earlier accounting standards, whatever accounting is there, we did that. And at that time, fair valuation was not done, and he's telling once upon a time in the past. Now, in the absence of any further information, what you have to understand is this company does not want to do Ind AS 103 application with retrospective effect. They don't want to do it. Sir, can they ignore like that? Of course, exemption is there. You can only do Ind AS 103. Hereafter, from the date of transaction, for whatever has happened, you can ignore Ind AS 103. So, the goodwill amount, whatever is there, that need not be updated now. You can stay put like that. So, here also the answer is do nothing. Next. Trade receivables include an amount of rupees 20,000 as provision for bad and doubtful debts measured in accordance with previous Gaap. So already 20,000 provision you have created. Now as per the latest estimates using hindsights, the provision needs to be revised to 25,000. I told you this case already. Estimate, sir. Estimate. Sir, when you are doing date of transition balance sheet, you are actually not standing on that date. No, you are standing at some future date. You are going back and you are preparing transition date balance sheet. When you are already standing in future, you would have more information about what happened to a particular estimate which you once upon a time made on the transition date. Sir, can I go back and change the estimate? No. No. Estimates what were there on the transition date originally, those estimates only should be continued. Just because today you are standing after 1 year, so what happened to that original estimate? You cannot revise the estimate based on further information. That is wrong, sir. So this also you have to ignore. So answer is do nothing. Sir, how many do nothing, sir? Okay, this much only. From here after you have to do something actually. Okay, maybe here also do nothing. Anyway, let's see it. Company had given a loan of rupees 1 lakh to an entity for a term of 10 years 6 years ago. 10 years loan 6 years ago we have given. That means remaining 4 years life is there. Transaction costs were incurred separately for this loan. The loan carries an interest rate of 7%. The principal amount is to be repaid in equal installments over the period of 10 years at the year end. Okay, so 1 lakh rupees is going to be recovered over a period of 10 years. So every year how much will come, sir? 1 lakh divided by 10. 10,000, 10,000, 10,000, 10,000. So till now how many years is over? 6 years. That means 60,000 you would have already recovered. So how much is pending? 40,000 is pending. So 40,000 should be your carrying amount. That 40,000 only earlier he was referring here in second point above. Long-term loans and advances include 40,000 rupees loan. 40,000 is this 40,000 only. How it became 40,000? I gave loan of 1 lakh, loan to somebody, long-term loan. In that 10,000, 10,000, 10,000 we recovered for 6 installments. Remaining 4 yet to come in future, 40,000. The fair value of the loan at the date of transition is 50,000 as against the carrying amount of the loan which presently amounts to 40,000. So obviously carrying amount we know, but the carrying amount the loan ka fair value as on today is 50,000. However, Ind AS 109 mandates to recognize the interest income as per EIR after the adjustment of transaction costs. Management says it is a tedious task in the given case to apply EIR with retrospective effect, and hence it's reluctant to apply the same retrospectively in the first time adoption. Okay. See, sir, in respect of financial assets, I do not know if you have revised, you will remember this, or else I will show you and then we will do this. Okay. In our mandatory exceptions, fourth point in our notes, in that B you read, for financial assets and liabilities where ACM has to be applied, if it is impracticable to retrospectively apply ACM and determine EAR, the entity can fair value the financial asset or financial liability on the date of transition and hereafter apply ACM. So what are you going to do now? The question is very clear. The entity is very clearly shouting that it is impracticable for them to go and adjust everything from the very beginning and do retrospective effect. No, fine. What will we ask them to do? Right? Simple. You follow ACM only. But as on today, once you do fair valuation on date of transition, so you will get one amount now, carrying amount, which is the fair value as on today. Your future cash flows are there. Map them. Identify whatever is the EAR and apply ACM from hereafter. Of course, we are not going to do all that exercise because we are asked to prepare only balance sheet on the date of transition. So as on today, the only accounting adjustment you have to do is from 40,000 carrying amount, you have to make it to 50,000 carrying amount, 10,000 rupees increase. Our corresponding effect where, sir? Where retained earnings only? Retained earnings. So you adjust. So here you have to do something. Fair value the loan receivable. And hereafter ACM. You also write side by side. Yeah, continue further, sir. In the long-term borrowings, 4,50,000 rupees of component is due towards state government. Okay, it's a loan again. Interest is payable on the government loan at 4%. However, market interest rate is 8%. The fair value of the loan is 4,20,000 on the relevant date. Okay, let's see. Where is your liability, sir? Yeah, this one. In your long-term borrowing 4,50,000, this 4,50,000, it seems you have taken it from the government at 4%. Market interest rate is 8%. And carrying amount is 4,50,000. But fair market value of the loan is 4,20,000. See, earlier point low, financial asset loan given, we have done one accounting. Now, F point low, there is a financial liability which is a loan. But remember, this is not a plain loan. It is a loan with concession interest rate, government loans. Standard says, in respect of government loans, you are not supposed to split the grant component and all. You are not supposed to do that. So what you have to do, whatever carrying amount is there, put it like that only. Remaining cash flows, whatever are there, map to them, identify the EAR, hereafter apply ACM. You are not supposed to do anything unless you will say that, sir, I want to do retrospective accounting. You can do that provided the information required for splitting was available on day one itself, like how we did in the previous sum. So as such here the answer is do nothing. You may ask me, sir, previous pitlow also it's a financial asset for which you did fair valuation on the transition date. Why are you not doing here? Sir, this is not a plain financial liability that you go and fair value once and hereafter apply ACM. No, it's a government loan, sir, concessional interest rate loan. Same sum, sir. If it was not a government concessional interest rate loan, then I would have fair valued it. And hereafter I would have applied ACM. But now what you have to do is, you are not supposed to do anything. Whatever carrying amount is there, a carrying amount, hold it like that. Whatever future cash flows are there, map, work out EAR and apply ACM. But no fair valuation today. Sir, it's simple, sir. You doing fair valuation today means indirectly a remainder portion looks like a grant portion and you are not supposed to identify the grant portion as on today. So that's the reason. Next. Under previous Gaap, mutual funds were measured at cost or market value, whichever is lower. Okay, fine. Under India's, the company has designated these investments at FVTPL. The value of mutual funds as per previous Gaap is 2 lakhs included in the current investment. However, the fair value of the mutual funds on the transition date is 2,30,000. Of course, if you want, you can fair value. It's not a problem. This is fair value investments as on today. No problem. Next. Ignore separate calculation of deferred tax on the above adjustments. See, on every item you go and change the carrying amounts of assets and liabilities. The moment you touch assets and liabilities balances, you must understand from our Ind AS 12 that your carrying amounts are changing. Because of that, your CA minus TB ka dabba also will change. That will result into DTL, DTA changes also. Correct? No? He's saying ignore separate calculation on the deferred tax on all the above adjustments. Assume net deferred tax income of rupees 50,000 on account of Ind AS transition adjustments. Ultimately, he is saying that overall put together there is deferred tax income of 50,000. So deferred tax income means, how should I understand, sir? Maybe DTA is getting created or DTL is getting reduced. Let us see in our balance sheet what they gave. We have a DTA is not there, DTL is there. So you can presume that deferred tax liability is coming down and you can presume. Or alternatively, you can create a DTA also. Information is not given, so that's okay. Required. Prepare transition date balance sheet of Shaurya Limited as per Ind AS and explain each and every item. So that's also, there is no big deal in this. Whatever we have discussed, one by one you have to do. So anyway, let me show you the grouping parts first. Later on we'll move there. So other current liabilities, what did we discuss? 390 will go into other financial liabilities. 60,000 will stay put in other current liabilities only. Look at the liabilities side. Financial liabilities heading. Under that, other financial liabilities. This is your adjustment number 1. The other current liabilities, which are statutory dues. This will sit there only. Okay, this is one point. Second point is regarding long-term loans and advances. That is on the asset side. Loans given 40,000 was there. To that you fair value 10,000 and ultimately became 50,000. That is regarding that. The remaining 110 were advances to staff. You must understand, in our Ind AS division 2 balance sheet, you don't have any heading called as loans and advances. Okay, you have financial assets heading. In that, loans ki separate head is there. Advances you have to group it under other financial assets. So this is for advances. Let me write. This is point number 2 here. Next, point number 3. Other non-current assets of rupees 2 lakhs consists capital advances or capital advances to suppliers. That should be there only according to me. For that there is no adjustment. Okay. Then fourth one. Other current assets include 3,50,000 current assets receivable in cash and prepaid of 50,000. I told you that will go into financial assets. So current low financial assets. So other financial assets is 350. The remainder will sit here. This is point number 4. Point number 5. Point number 5 is regarding a wrong provision created towards dividend that you have to cancel it. So provisions, where are you going? Oh, here. This is your point number 5, where 2 lakhs provision you have removed. So these are the grouping errors. Now coming to the main adjustments. Sir, PPE we asked to add 5 lakhs. Let's see directly. PPE 5 lakhs added. Okay, sir, happy. Intangible asset, this fellow does not want to fair value, leave it. Goodwill, he does not want to recreate, leave it. Trade receivables flow, he is asking you to create an extra provision of 5,000, but you are not supposed to do, because based on hindsight you should not revise the estimates. Do nothing. Loan receivable 14, you have to make it 50. That we have seen, he has made it here. Second adjustment. Long term borrowings, you are not supposed to do anything. So 4,50,000, it will stay put like that only. Since that is a government loan, you are not fair valuing it and all. Okay. Next, mutual funds investments are there. You have to increase it by 30,000. Fair valuation is there. So here he increased it by 30,000. Deferred tax income you have to recognize 50,000. I think DTL he would have reduced. See here. That's all, sir. Because of this, your retained earnings balance. Balance as per original. This is what is given in the balance sheet. Loan fair value 10,000 increased, that one. The loan given increase, but it's an asset increase, so it's a plus. Mutual fund increase is a plus. DTL decrease, that is also a plus. Provision not required reverse plus. So all our additions on it became 27,90,000. That's all. For each item you can write the main what is Ind AS 101. Say all the provisions principles you have to write. If you do not write that, you will lose marks for this. So this question is newly added. It's important. So we'll move on to test your knowledge questions. Turn back, so go to page number 672. So guys, moving on to the test your knowledge questions on the back side in page number 672. Go to first question. Company A intends to restate its past business combination with effect from 30th June 2080, being a date prior to transition date. If business combinations are restated, whether certain other exemptions such as deemed cost exemption for PPE can be adopted. So good question indeed. Anyway, listen, the question is this, sir. Suppose this is your date of transition, okay? Suppose from some day previous here onwards, you want to restate your business combination. So Ind AS 103, from this date onwards, retrospectively, you want to apply. Ind AS 103 retrospectively applying means whatever assets and liabilities you have acquired from the acquiree on that date of acquisition, you have to measure them at fair values on that date. And had you applied Ind AS 103 on that date, by now what carrying amounts would have been there, that amounts should be appearing on your balance sheet on the date of transition. That is the meaning of Ind AS 103 application retrospective, isn't it? Had I applied Ind AS 103 once upon a time on the past, when I acquired controlling interest, controlling power on the other entity, then what amounts I would have recorded at that time, and by now what would have been their carrying amounts, that you have to reflect in your balance sheet on the date of transition. Now this fellow says, I am not selecting this option of exemption from Ind AS 103, I am doing retrospective application, but I want to take deemed cost exemption. Deemed cost exemption of previous Gaap carrying amounts means what? Whatever amounts were appearing in your balance sheet as per AS, that you want to bring it into Ind AS balance sheet as it is. That is PPE and all, you have the choice, right? So he's saying, if I select Ind AS 103 retrospective effect, if I decide to apply Ind AS 103 with retrospective effect, can I also take deemed cost exemption for PPEs? And if I do that, will there be any clash between them? For that, the answer is very simple, sir. Those PPEs which are appearing in your balance sheet, which are existing because of this business acquisition in the past, that on that you have to apply Ind AS 103 completely, because you decided to do so. In respect of other assets, other PPEs which you have purchased it on your own and they are not as a result of this business combination, for them you can apply deemed cost approach. So once you decided to apply Ind AS 103 retrospectively, so those PPEs which you have acquired in the course of business combination, on that how can you take deemed cost exemption? You cannot take. For other PPEs, you can definitely take deemed cost exemption. That will be your answer. Next. E.Srinivas was using cost model for its PPE till 31st March 02 under previous Gaap. The Ind AS became applicable for the company, to the company for the financial year beginning 1st April 20x2. On 1st April 20x1, which is the date of transition to Ind AS, it used fair value as a deemed cost in respect of its PPE. Fine. See, transition date, PPE, you have three choices. So one of the choices, you doing fair valuation. So he selected fair value. E.Srinivas wants to follow revaluation model as its accounting policy in respect of PPE for the first annual Ind AS financial statements. So fine, what they want to do, normally in the course of Ind AS they want to adopt revaluation model, but on the transition date they selected fair value option, and fair value only is treated as deemed cost. On which date? On the starting date, transition date. From here after they want to apply revaluation model. Whether use of fair values as deemed cost on the date of transition and use of revaluation the first annual Ind AS financial statements, would it amount to a change in accounting policy? No. Means, see, the question is this. On the transition date, if you see, ideal rule is what? You have to apply Ind AS 16 retrospectively. Since you pleaded that you cannot do, the standard gave you two extra options. fair value it, and I will believe that that only is your starting point. If you can't fair value whatever is the carrying amount in the previous gap that you have, it is bring forward. Okay. Now what this fellow has done is he has taken fair value on the transition date option. That fair value we treat it as a starting point cost. It doesn't mean that you are following cost model. You will follow whatever is permitted in India 16. India 16 permits cost model also, revaluation model also. On transition date you have fair valued means we will believe it is as good as you have acquired asset on that date. From here onwards, which method you will apply, the India is your choice. So transition date fair value. Hereafter also he wants to follow revaluation model, which means the asset has to be fair valued at frequent intervals, right? So he's asking, is it a change in accounting policy? No, because transition date key it was appearing at fair value. Hereafter also you will be doing revaluation model, which also says fair value, and therefore we should not read this as a change in the accounting policy. Next. Y Limited is a first time adopter of India's. The date of transition is 1st April 2005. On 1st April 2000, that means before 5 years, it obtained a 7 years $1 lakh loan. It has been exercising the option provided in paragraph 4646A and has been amortizing the exchange differences in respect of this loan over the balance period of such loan. So FCMI TDA. If it is related to depreciable asset, you have to adjust to that. If it is not related to depreciable asset, you will transfer it to FCMI TDA, and FCMI TDA balance has to be amortized over the period of the loan. On the date of transition, Y Limited wants to discontinue the accounting policy as per previous Gaap and follow the requirements of Ind AS 21 with respect to recognition of forex differences, whether the company is permitted to do so. Of course, see, we have given an optional exemption. What is that optional exemption? If you want to continue that, continue. You don't want to continue, chalo, Ind AS 21 you will apply prospectively. That's fantastic. No, Ind AS 21 if you want to apply, which says take all exchange differences to P&L statement, so you will do that. So obviously the exemption is if you want to continue, you can continue, or else you can apply Ind AS 21. A company has chosen to elect the deemed cost exemption in accordance with Ind AS 101. However, it does not. Deemed cost exemption means PPs and all previous carrying amounts, they must be fair valuing them. However, it does not wish to continue with its existing policy of capitalizing exchange fluctuation on long-term foreign currency monetary items to property, plant and equipment. That is, it does not want to elect the exemption available as per Ind AS 101. In such a case, how would the company be required to adjust the foreign exchange fluctuations already capitalized to the cost of PPE under previous Gaap? Anyway, listen, the story is this, sir. This fellow has got a foreign currency loan. That foreign currency loan is related to a depreciable asset. In the past, what he has done is all the exchange differences he will be capitalizing it towards PP. Now, on the transition date, he decided that he decided to take deemed cost exemption, which most likely is the carrying amount whatever is there of the PP under AS, that as it is he wants to bring it into Ind AS. Sir, is it allowed? Of course it is allowed. But in respect of the loan, foreign currency loan, he does not want to follow paragraph 4646A. He does not want to do that. So hereafter he will follow Ind AS 21 like in third sum above. So the question is, when hereafter exchange differences are going to PRL, 4646A exemption he does not want to continue. What about the exchange differences which are already capitalized into the cost of the asset? That you need not adjust. Deemed cost exemption means that only, no sir. Without making any adjustments, whatever carrying amounts are there as per your previous Gaap, that as it is we will bring forward into Ind AS as a starting point. That only is the meaning of deemed cost. So again, if I ask you to remove all the differences and all, it's as good as I am asking you to apply Ind AS 16 and Ind AS 21 retrospectively. That need not be done. Whatever exchange differences are already capitalized in sitting in PPE, let them sit there. We cannot do anything for that. Fifth question is a little bigger one. We will do it towards the end. Next, go to sixth one. Mathur India Private Limited has to present its first financials under Ind AS for the year ended 31st March 2003. Therefore, the transition date is 1st April 2001. That's fine. The following adjustments were made upon transition to Ind AS. Now, what are these adjustments? The fair value of the land. Sir, the company opted to fair value its land on the date of transition. Sir, land is part of PP and they can fair value. The fair value of the land on 1st April 01 was 10 crores. The carrying amount on 1st April under existing Gaap was 4.5 crores. That means there is a rise of 5.5 crores due to fair valuation of the land. Next, the company has recognized a provision for proposed dividend of 60 lakhs and DDT of 18 lakhs during the year. It was written back as on the opening date. What is this, sir? 68 lakhs, 60 and 18, 78 lakhs. You know, crores we are talking. So 0.78 crores proposed dividend reversal. Because proposed dividend, how can I create a provision? The company fair values its investment in equity shares on the date of transition. Okay. The increase on account of fair valuation of shares is 75 lakhs. That is 0.75, you can say, crores. The company has equity capital of 80 and redeemable preference share capital of 25. Redeemable preference share capital is now to be treated as a financial liability, but earlier under Gaap used to show it under shareholder funds. The reserves and surplus as on 1st April 2001 before transition to Ind AS was 95 crores, representing of 40 general reserve and 5 crores of capital reserve acquired out of business combination, and balance is surplus in the retained earnings. So as you can see there, in your 95, 40 if you remove and 5 if you remove capital reserve, 45 if you remove, remaining balance is 50. That is the retained earnings balance. Our retained earnings balance has to be now adjusted for all these above discussed adjustments. The company identified that preference shares were in the nature of financial liability, that anyway we can identify. What is the balance of total equity on 1st April 01 after transition? Show reconciliation between total equity as per AS and as per Ind AS to be presented in the opening balance sheet. How simple, sir? So, from your existing equity balance, you have to make this adjustment, this adjustment, this adjustment, making 3 adjustments, and then existing equity heading low, preference share capital is there, that you have to remove it and you have to show it under liabilities. So anyway, he's asking only equity wala component, you just have to do that. I'll just show you the answer. It's a very simple one. Yeah. This is your equity capital 80, sir, let it be there. Your general reserve of 40, that's fine. Capital reserve is 5, already there, is fine. Retained earnings balance is 50 originally. To that, land increased of 5.5 crores. Proposed dividend provision, whatever you have created, you have to write it back, 0.78. Investment value 0.75 increase. So net 102.03 is your total reserves. So this is your final equity balance, 182.03 as per Ind AS. Then he asked a reconciliation statement. Reconciliation means under previous Gaap, what was my equity? New Gaap on transition date, what is your equity? That is Ind AS, what is your equity? What are the changes? So previous Gaap low, your equity was 200. How it's 200? Equity 80, equity share capital 80, preference share capital 25, 105, total reserve surplus 95, total is 200. Now it is 182.03. Now what are the changes? First, remove preference share capital, 25 gone there. Proposed dividend and all, you earlier treated as a liability, now you add it back. Land fair valuation will increase, investments fair valuation will increase. This the same 4 adjustments, whatever you have done here, same here. Only thing is, there you did not touch preference share capital removal because you are talking only about the equity retained earnings adjustment there. Here totally. Here reconciliation is there. So here gross you have taken in the past, from that you are removing. If you ask me direct equity under Ind AS, then I will not even take preference share capital in the first place. No? So preference share capital adjustment will not be it. Next, coming to the last question. ABC Limited is a government company and is a first time adopter of Ind AS. As per the previous Gaap, the contributions received by ABC Limited from the government, which holds 100% shareholding in ABC Limited, which is in the nature of promoter's contribution, have been recognized in capital reserve and treated as a part of shareholder funds in accordance with the provision of AS 12 government grants. Oh, stop there. Sir, I am ABC, I am a government company. Government ninchu we received some funds. That funds, as per AS 12, we have treated it like government grant in the nature of promoter contribution, and we parked it completely under the heading of capital reserve. The existing treatment. Question: State whether the accounting treatment of the grant is in the nature of promoter contribution as per AS 12 is also permitted under India AS 20 government grants. Okay, fine. If not, then what will be the accounting treatment of grants recognized in capital reserve as per previous Gaap on the date of transition? Listen. Sir, we have studied some exemptions and in that regarding government grants, we did not regarding government grants in the nature of promoter contribution and all, there is no exemption and all, which means India has to be applied retrospectively. What we studied exemption is if you receive a government loan, then don't do any retrospective adjustment and all unless you have the information on day one. Correct? No? So leave that. Anyway, coming here. Strictly speaking, if you receive a grant from the government in the nature of promoter contribution, AS 12 we all used to transfer that to capital reserve. I think you remember that. But under India AS 20, you don't have anything called as a grant getting accounted under the name of capital reserve. No. Every grant has to come to PRL. Of course, sometimes immediately it will go, sometimes over a period it will go. So temporarily we'll classify it as deferred income. But a grant sitting under the heading of capital reserve is inappropriate. So if this is a government grant, in the nature of promoter contribution, then definitely you have to remove it from capital reserve and show it under the heading of deferred income. Because India, starting the previous session we discussed, recognize assets and liabilities as per India's point number 1. De-recognize items which are not assets and liabilities. Remeasure, reclassify. This is reclassify, it will come. Okay. All this when, if that is government grant. Sir, what is this question, sir? How can it not be a government grant? See guys, that is a government company. That means government is the owner of that company, ABC Limited. And if government is giving money to this entity, there are two possibilities. Possibility number 1 is right, it may be a grant. So whatever discussion we have done, just reclassification should be sufficient. But if you say, sir, government has given money not in the capacity of government but in the capacity of a equity participant, because e company who is the sole owner government, if government has given any money to this entity in the capacity of a shareholder, then it is an equity contribution, then it will stay as equity item. Then it's like just like a shareholder contribution to the company. Okay, so it depends on what form we have received the money. So you cannot write a conclusive answer. You have to evaluate both the scenarios and write both the possible cases ke answers. Let's see. The entity needs to determine whether the payment is provided as a shareholder contribution or as a government. Equity contributions will be recorded in equity. Then you record in capital reserve, you don't have a problem. Whereas grants will be shown in the statement of profit and loss. So, where it is concluded that the contributions are in the nature of shareholder contributions and are recognized in capital reserve under previous Gaap, the provisions of paragraph 10 would be applied, which states that except in certain cases, in the opening balance sheet you have to recognize, de-recognize, all these points are there. And then, when it is concluded that contributions are in the nature of government grants, the entity shall apply the principles of India AS 20 retrospectively. And here the principle is telling, you have to recognize it as income over the periods in which entity recognizes the expenses on related costs for which grants are intended to compensate. Therefore, it does not permit recognition of government grants in the nature of promoter contribution to directly to shareholder funds. So shareholder funds flow, if you want to sit, it should be in the nature of equity contribution. Then shareholder funds flow you sit. I don't have a problem. But if it is received in the capacity of the government, has the grant, if the money is received in the capacity of government, if the government is acting like government and not like shareholder, in that case it cannot sit under the heading of shareholder funds. It is to be treated as a deferred income and over a period it will be released to PRO. So that is the answers. And then we are left with only one question, so it's relating to joint venture. Let's move on. Go and pick up question number 5. Okay, sir. Sir, before we read this case, I'll just try to remind you something. You understand this, sir. This is little important only. So please pay attention. This is the last concept we are discussing. Sir, I am talking about accounting standard 27. Oldest. And then we have our Ind AS 111, which is joint arrangements. This is also joint ventures and all. Here also it is joint operations and joint ventures, both are covered. Standard name is joint arrangements. Okay, now listen. Here in AS 27, for joint ventures, there is nothing called as equity method. Equity method we used to do only for associates, not for joint ventures. Joint venture ki, we have to do something called as proportionate consolidation method. So proportionate consolidation method means what? Proportionate consolidation method means if there is a joint venture, suppose I am a 60%, let's say I am a 50% owner in that. So our joint venture assets and liabilities will be there. No, all assets, each asset you take. In that 50% you consolidate, 50% asset you consolidate, 50% liability, like that. My share of assets, my share of liabilities, I will bring it into my balance sheet and I will do consolidation. That is proportionate consolidation method. Okay. In Ind AS 111, we have joint arrangements. Joint arrangements we further classified into joint operations and joint venture. I hope you remember. Joint venture means there should be a structured entity and all. Then we'll see further cases like are the venturers having interest in the net assets or individual assets and liabilities, or whether the output of the joint venture joint arrangement is ultimately coming back to the venturers only, and some conditions are there. And if you establish that it is a joint venture, then you have to apply something called as equity method. Now equity method, how to apply, that discussion is given under Ind AS 28 for us. So equity method, whatever associate you do, same thing you will do for joint venture also. Now equity method, how to do? First you should take the cost of the investment. To that you add your share of post acquisition profits or losses of the associate or joint venture. You keep on adding, there's some adjustments and all. Okay, that is equity method. But if it is a joint operation, here also we are indirectly suggesting proportionate consolidation method only. Means suppose there is a company, but which is classified as a separate entity only, but still classified as joint operation, and I am a 50% owner in that company. So your share of assets, your share of liabilities, you incorporate and you prepare consolidated balance sheet. That is a proportionate consolidation method. Sir, where is the difference now? When you are migrating from AS to Ind AS, what type of difference will you face? What type of difference will you face? Carefully observe, sir. What difference you will face is, in the past accounting standards, you compulsorily you would have done proportionate consolidation method, right? But when it's coming into Ind AS, if you are still classifying it as, see, earlier there was joint venture, all type of joint venture, you will do proportionate consolidation method only. In AS 27, under Ind AS, you have to evaluate whether that arrangement is classified as JO or JV. If it is classified as JO, then there is no problem. Why? Already you applied proportionate consolidation method only. Now also you will continue with that. Migration will be no issue at all. As it is, you can carry forward also. Ind AS 103 and all gives you prospective application choice and all is there. So that's not a problem. Deemed cost exemption also there for you. So if here also here anyway proportionate consolidation method, and here if it is classified as a joint operation, then your life is simple. But in Ind AS, if that is classified as a joint venture, if in Ind AS it's classified as a joint venture, then just imagine, sir, in your balance sheet you have done consolidation of assets and liabilities, of course, your share in the past. But in equity method, you are not supposed to do consolidation only. All you have to do is keep the investment and do equity method. Are you understanding from where to where? You have already prepared a consolidated balance sheet where to your assets, that fellow's share of your share of that fellow's assets, to your liabilities, that fellow's share of that fellow's liabilities are your share and all, you have capitalized like this, consolidated like this. From this, what you have to reach now is assets and liabilities yours should be there, and you should create investment in joint venture separately, which will be appearing at equity method. This is what you have to do from old AS to new Ind AS. So if you are classified as a joint venture, this is the accounting you have to do. Now what Ind AS 1 guidance it gives is how to measure the value of this investment. Of course, hereafter you will apply equity method. On the transition date, how will you measure the investment in JV ki corresponding amount? Any guesses? You can think peacefully, you'll get an easy idea. That is, what are you doing from this balance sheet to that balance sheet? Whatever assets you have consolidated, that you are going to remove, and investment you are going to create. So what is going to happen now? Whatever assets and liabilities you have consolidated earlier, all that you remove, a net asset ka amount will be there, no? That only you will go and call it as investment in joint venture. That's it. That's it. And here when you have goodwill, if any goodwill relating to joint venture is there, that goodwill also you have to include it in the cost of investment. So this you are going to remove, this you are going to remove. Like a net assets chunk you are removing from your balance sheet. Amount only will now become your investment in JV. Plus any portion of the goodwill if it relates to JV, that also will be added. Very simple provisions. When you see the sum directly and all, it might be confusing, but at a numerical point and a conceptual point, if you observe, it's a very, very easy case. Presently, I have done proportionate consolidation. 50% of assets, 50% of liabilities and all I clubbed. Now I am not supposed to club because in JV there is no proportionate consolidation. You have to do equity method. So you have to remove all the assets liabilities which you have consolidated. In that place, investment should come up. So what is going to happen? Assets liabilities you remove, whatever you consolidated, ade amount you go and recreate as a investment. If in the consolidated balance sheet goodwill, if any goodwill belongs to joint venture, in that goodwill also you go and incorporate. That's it, sir. That's it. There's nothing else. It's a very logical sum, but the sum is important, guys. Okay, please read. XYZ Private Limited is a company registered under Companies Act following accounting standards, Companies Accounting Standard Rules 2006 and old days. The company has decided to voluntarily adopt Ind AS with effect from 1st April 2002 with a transition date 1st April 2001. Okay. The company has one wholly owned subsidiary and one joint venture which are into manufacture of automobile spare parts. Okay. The consolidated financial statements of the company under Indian Gaap are as under. So they have given consolidated financial statements. 31st March 2000, transition date of 1st April 2001. So this date basically. Share capital, reserves, long-term borrowings, provisions, all this are there. Here look at this. Goodwill on consolidation of subsidiary and JV. So this goodwill is purely related to subsidiary and JV consolidation goodwill. Okay. Next. Investment property, long-term loans and advances, trade receivables, investments and current assets. Okay. Additional information. The company has entered into a joint arrangement by acquiring 50% of the equity shares of ABC Private Limited. So our company name is XYZ. We have a joint venture with ABC. Presently, the same has been accounted as per proportionate consolidation method. That means in your assets and liabilities, JV assets and liabilities are also included. The proportionate share of assets of ABC which are included in the CFS of XYZ are as below. So how much you have consolidated? PPE 1200 belongs to your share of JV's PPE. Similarly, assets, loans and advances, trade receivables, other current assets, trade payables, short-term provision. So what you have included, they have given. The investment is in the nature of joint venture as per Ind AS 111. Joint venture means you have to apply equity method for which you need basically starting point. No, that is exactly what we have discussed earlier. The company has approached you to advise and suggest the accounting adjustments which are required to be made in the opening balance sheet as on 1st April 2001. Sir, basic common sense though, if you see what you have to do on transition date balance sheet. Sir, a second column transition date column balance sheet is the 31st March 2001. Take that balance sheet. From that balance sheet, PP lo remove 1200, long term loans will remove 405, trade receivables will remove 280, other current assets will remove 50, trade payables will remove 75, short term provisions will remove 35. All these amounts, whatever you are removing, the amount will be now included in the same balance sheet with the name of investment in joint venture. Okay, so that's all you have to do. But one small point is there. What is that point? Look at this goodwill. A goodwill 1507 is there. That is not consolidation of subsidiary goodwill. The consolidation of subsidiary goodwill also, consolidation of joint venture goodwill also. Sir, how much in that 1507, how much belongs to joint venture? That we do not know, sir. That we have to go and proportionately work out and solve. So when you are removing 1200 from PPE and all like that, a goodwill also some amount you have to remove. Now how much you have to remove? You work out that. Remove all these items. PPE, some amount, long-term loans, trade receivables, current assets, trade payables, short-term provisions, and goodwill also. So 1, 2, 3, 4, 5, 6, 7 items you have to remove. Whatever amounts you have removed from the balance sheet, recognize it as an investment in joint venture. That's all. Prepare the final balance sheet. Game over. So this is exactly what you have to do. So let's see. PP 1200, goodwill 119. Refer note below. We'll refer it later on. Long-term loans and advances 405, trade receivables 280, other current assets 50, trade payables, that's negative, no, liability, short-term provisions, deemed cost 1944. As such, if you do net assets here 1200, 405, 280, 50, 75, 35, you will not get that 1944 because goodwill is not there in this. So if you understand goodwill, how it's worked out, calculation of proportionate goodwill. What he has done is take the total net assets of the company. That means on this date, this minus this. You will get the net assets of the company as a whole. Okay. Total 23,137 net assets ki there is a goodwill of 1507. What are the net assets relating to joint venture? Net assets relating to joint venture are 1825. 1825 ki correspondingly how much goodwill is there? Sir, how did you get 1825? This is 1825. Sir. You can check that if you want. So, pakka 1825. So 1825 ki correspondingly how much goodwill will be allocated? You get your answer as 119. So from your balance sheet, each item lo some amount you are removing, no? Ala goodwill 1507 nunchi remove 11. Net assets total you removed, that came to 1944. That 1944 we will now call it as deemed cost of the investment in JV. That's all. PP lo removed 1200. Intangible assets 119 he removed. Long term assets of 405. Newly created non-current investment in JV. Trade receivable 280 you removed. Other current assets 50 you removed. Trade payable short term provisions you removed. That's all. You will not find any difference and all. Balancing figures, adjustments and all will not come, because whatever items of net assets you removed, including goodwill, that amount only you created it as investment in joint venture. So that's the reason you will not get any differences and all. So that's also that's all. This is the last question and it's an important one. Here care must be taken that whatever balance sheet they have given in the question, that obviously is as per old days, but what they asked you is to prepare a balance sheet as per India. So you should be doing this in division 2 format of schedule 3. So you know all your headings and all, so accordingly you prepare. So that is that, sir. Sir, with this we are done with India's 101. Next session we'll meet with another standard. Yeah, thank you.